Hello and welcome to this episode of Macro Sutra. I'm Akanksha Mishra. The Union Budget for the year 2025-26 came out last week and there's quite a few interesting features in it. There's tax cuts for the middle class, a relatively flat capital expenditure, and a continued focus by the government on fiscal prudence. To discuss all things budget and analyze the robustness of the fiscal math of this year's budget, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much for being with us, Radhika.
Thank you, Akanksha.
Now let's get right into it with probably the most important takeaway from this year's budget, which is that there's going to be no income tax for people that are earning up to rupees 12 lakhs per year. Do you think that this move is going to boost consumption in the economy? And if so, how substantial will this boost be?
Yes, so as you rightly pointed out, this is going to be one of the most important takeaways of this budget, that there has been substantial tax cuts announced for the middle class, and in terms of the revenue foregone, it amounts to almost rupees 1 lakh crore of revenue that has been foregone due to these tax cuts, and also around 12 lakh income is going to be tax free, and if we include the salaried class, the standard deduction, the tax free limit rises to rupees 12.75 lakh. So that is the amount of and for each of the remaining tax slabs also there is a rejig that has been done in order to reduce the tax burden. So certainly it will increase the disposable income in the hands of people, but the next question is whether it will boost consumption or not, and by how much. Now that depends on multiple factors. Firstly, it depends on the marginal propensity to consume, that is, from the additional income, how much is going to be spent on consumption and how much is going to be saved. Now, for relatively lower income tax brackets, the marginal propensity to consume tends to be higher. So they would like to increase their consumption on non-durable goods as well as on durable goods. But there are, as I said, other factors as well. One is that if we look at the trajectory of household savings, that has been declining, and as per the latest data which is available for FY23, household savings is only 5.2% of the gross national disposable income. So some of the increase in disposable income would be used to build back the household saving. So it may be kind of a leakage from the flow of income, and it may not lead to increase in consumption. The other important aspect is also that a lot of households are leveraged. They have borrowed a lot from banks, and as we've seen that retail bank credit has been rising in double digits. It's been increasing till now, till June of last year. Retail credit, consumer credit was rising at around 20%. So some of the increase would also be used to pay back the loan. So there will be tendency to pay back loans, to deleverage, to save, and a part of it certainly would be used to increase consumption. But certainly there is going to be some impact. It's not that the impact is not going to be there, and the impact is going to be relatively material. As we look at the FMCG companies, they find it quite optimistic that it's going to increase consumption.
That's great. Now let's move on and let's look at the fact that last year's revenue receipts were lower than expected. They saw a shortfall. So given that, what do you think about the tax projections for the upcoming year? Are they realistic or not?
Yeah, so there is there is optimism on that front, and first let us, as you rightly pointed out, let us talk about the current year's revised estimates, because if you look at the revised estimates of the current year that will end on 31st March, the revenue receipts are likely to be lower by 41,000 crore, and tax revenues to the center, that is the net tax revenues, are projected to be lower by 26,000 crore as compared to the budgeted projection. So this is kind of a departure from the previous years, because if we look at previous years, the government used to keep very conservative assumptions on tax, and it used to do well on taxation. Tax receipts used to be higher than budgeted, and then some of that excess used to be allocated to finance some additional spending, some unanticipated spending, and so on. But this time around, that's not the case, because the receipts are lower than what had been budgeted. And then again, for next year as well, we see that the assumptions for some of the taxes, not all, but overall, if we look at the gross tax revenue, the growth rate projected is 10.8%, which is quite modest, which is quite realistic, in line with the nominal GDP growth assumption of 10.1%. So there we see that the tax buoyancy comes to somewhere around 1.1, which is 1.1x, which is quite reasonable. But on two of the important taxes, that is direct taxes and corporation tax, we think that some of the projections are optimistic, given that we are cutting taxes, and then also we are projecting that income tax collections will rise by 14.4% over the revised estimates of last year. That seems a tad optimistic. And so is the case with corporation tax. There also the tax collections are assumed to rise by 10.4%. And if we look at the revised estimates of this year, corporate tax collections have grown by 7.6%. So again, given the uncertainty, because corporate tax collections depend on corporate profits, and if corporate profits are going to remain subdued, given the uncertainty in the global environment, given the subdued nature of exports, given the tariff wars, uncertainty on that front, so it is not likely that we'll see a big turnaround in corporate profitability, and hence corporation taxes are not likely to witness a very sharp growth. And therefore, on income taxes and corporation taxes, we feel that there is a optimism on that front and may not be achieved. But on the other taxes like the custom duty and excise duties, growth rate is assumed to be quite modest, around 2 to 4%. And that is again because custom duty, we are in the process of rationalizing our custom duties in line with the global trend, in line with trying to improve the manufacturing sector competitiveness, on which raw materials we have to reduce custom duties so that our manufacturing sector gets more competitive. So on custom duty, we are okay. On excise duties, we are okay. Only on income taxes and corporation taxes, there is the projections are on the higher side.
That makes sense. Now moving on, can you tell us a little bit about what the numbers of this year tell us about the government strategy via disinvestments and dividends?
Yeah, so now from tax we move to non-tax revenue, which is the dividends, and we move to non-debt capital receipt, which is disinvestment. Now when we talk about dividends, again the dividends are from the Reserve Bank of India and state-run banks and public sector entities. There again the government has set quite an optimistic target, which is of 2.56 lakh crore dividends from RBI and state-run banks. Now notably this year, that is the current year, the government got a bumper dividend from RBI, 2.1 lakh crore, which helped the government cushion its fiscal deficit in a period when nominal GDP growth is slowing, in a period where tax revenue collections are slowing. So we got a good boost in the form of RBI dividends. Now whether we are going to have that same kind of trajectory next year, it's not certain, because there is, as I said, there's going to be a lot of uncertainty. Global interest rates are now declining. So the income that we will get on RBI's holding of securities, US Treasury bills and all, that will be lower. So, and also because of uncertainty, RBI would have to provision a greater amount to tide over uncertainty. So it's not very certain that again this year again the RBI would be able to provide a bumper dividend, and therefore there could be some optimism there. Also maybe there is some the RBI dividend could be lower. So we are not sure. It's quite uncertain at this point in time, because as the year goes by, we will see how the things pan out. On the disinvestment, there is disappointment, that is the non-debt capital receipts, because now we don't get to see this item called disinvestment. Now it is clubbed under non-debt capital receipts as miscellaneous receipts, and there we see that disinvestment and asset monetization, these numbers are clubbed together. For the current year, the budgeted amount was 50,000 crore, but the revised estimates show 33,000 crore. So clearly there is very limited aptitude for state governments disinvestment. So there is limited appetite for sales of government stake sales in PSUs, and therefore there is limited disinvestment. But again, we are seeing for the next year the government is budgeting 47,000 crore. So it may not be the case, because this year we are not achieving. So, and given that there is no visible change in the strategy of the government towards disinvestment, so it's not clear whether this target would be achieved next year as well. What is important is the other part, which is asset monetization, which the FM announced in her budget speech, that they will come up with asset monetization 2.0, where they will monetize the existing brownfield investment, use that money to plow back fresh capital in greenfield investment. So that is something, if the implementation challenges can be overcome, then that is something that can add more revenues.
Yeah.
So that is very important, that asset monetization gets in a mission mode, and we are able to garner resources so that there could be investments for fresh capital creation.
That's great. Now, let's move on from revenue to expenditure. There's obviously been a lot of talk about capital expenditure in this year's budget remaining quite flat. But in your article, you mentioned that the Capex thrust for this year is non-trivial.
Right.
Can you explain what that means?
So what I mean to say is that, there's a lot of this concern that Capex has not been increased by a substantial amount. But what we need to also see is that first we need to address the constraints in capital expenditure this year, that why we were not able to achieve the target for the current year. Of course, there was election-related uncertainty, there were monsoons in certain regions, but beyond that also we see that there are these implementation bottlenecks. So first, it is important to fix those bottlenecks and also see ministry-wise. And when we see ministry-wise, the Capex, this 11.1 lakh crore, or the revised estimate for the current year, which is 10.18 lakh crore, we see that the underspending is done by two ministries, Ministry of Finance and Ministry of Defense. So first we need to fix the reasons for the underspending by Ministry of Finance, in particular the Department of Economic Affairs. Within Department of Economic Affairs, there is substantial underspending of Capex. So that needs to be addressed first, because in the Department of Economic Affairs, a lot of money was allocated towards new projects, and a large chunk of that remained underspent in the current year. And again, when we talk about 11.21 lakh crore for the current year, again we are seeing budgetary allocation higher for, again, Ministry of Finance and Ministry of Defense. So my point is that, again, this number is not small. If we are able to achieve this number, it is good. But what is important is to first fix the reasons for the shortfall, go in a disaggregated manner to see in which ministry there is a shortfall. There is no shortfall in Ministry of Roads and Highways. There is no shortfall in Ministry of Railways. So there is shortfall, as I said, in two ministries, Finance and Defense. First, address those problems and then talk about raising it further.
That makes sense. Now, the fiscal deficit numbers show that the government has managed it quite well. On the face of things, it's done well. But is it better to achieve this target by increasing revenues or by decreasing expenditure the way that the government is currently doing?
Yeah, so that's an important question, and that balancing is always to be done by the government when it strives to stick to the path of fiscal consolidation. But this time, the focus, how the path towards fiscal prudence is sought to be achieved, is primarily by expenditure cuts. One, we saw that for the current year, we are seeing that there is substantial shortfall on the capital expenditure part, almost 1 lakh crores underspending on Capex, and which is helping us to bridge our fiscal deficit. And the next year as well, again, because we have fixed 11.18 lakh crore as the 11.21 lakh crore as the target, unless the implementation bottlenecks are fixed, there could be shortfall again. But more importantly, let us look at the revenue expenditure. Now, revenue expenditure is pegged at somewhere between 6.6 to 6.7% growth over the revised estimates, revenue expenditure for the coming financial year. Now, within that, the interest payments is showing a steep surge of 12%. If we exclude interest payment, which is like your committed expenditure, which you have to do, what is left is the revenue expenditure excluding interest payment, and that is projected to grow by a very modest 4.2%. So, revenue expenditure excluding interest payments is rising just by 4.2%, and it's been declining from COVID. After a COVID, during the COVID, there was a surge in both revenue expenditure as well as revenue expenditure excluding interest payment. But since then, we are seeing a substantial, as a share of GDP also, and as in terms of the growth rate also, we are seeing that there is a decline.
Okay.
Revenue expenditure per se, there is decline, no problem. But excluding interest payments also, if there is a decline, that means that there is little flexibility with the government, there is little fiscal space to maybe spend on productive expenditures, to maybe spend on some centrally sponsored schemes, on health, education, and so on. So that is something that needs to be thought over, that excluding interest payments, the revenue expenditure excluding interest payment is rising by a modest amount year after year. And what is the problem? Is it the problem lies with the states? And that is exactly the case, because centrally sponsored schemes, the allocation has been slashed by almost 91,000 crore for the next year. Why? Because the states were not able to spend. So if the states are not able to spend, they have to, because they don't want to just keep the money idle.
Yeah.
If they're not able to spend, it's now only on need basis that money is dispersed. So all these things, what is the spending capacity of states, all these things need to be considered when we talk about expenditure cuts.
That makes sense. Now, finally, let's look at how do you view the government's recommitment to pegging its fiscal policy to a debt to GDP ratio rather than having a fixed fiscal deficit target.
Yeah, so that's the change that has happened, that's going to happen from the next financial year onwards. For the next financial year, it's terminal. We have fixed the fiscal deficit at 4.4% of GDP, that is FY26. Beyond that, the government has outlined a medium term fiscal trajectory, which is expressed in the form of debt to GDP ratio. Now, debt to GDP ratio is a very critical metric which is watched keenly by the sovereign credit rating agencies. So now when they are looking at upgrading India's sovereign credit rating agency, they will look at the outstanding stock of debt as a share of GDP. And that is something that needs to come down, because if we look at our debt to GDP ratio, it is on the higher side as compared to our emerging market peers. So that is something that needs to be reduced. And if there is this, we are changing the fiscal framework to target debt to GDP ratio as the main anchor. It is something which is a positive move for the sovereign rating agencies as well. Now, there can be debate on the trajectory. Because the target is that by FY31, the debt to GDP ratio should come down to 50%. This is for the central government. There could be debates whether this is gradual, whether this is too ambitious or not, but at least they have articulated this framework. So this this imparts transparency to the fiscal framework, and to that extent, it's a positive move.
That's great. I think we should take some time to look at a couple of audience questions. And there's a few on the fiscal deficit target set by the government. So the government plans for it to go down from 4.8 to 4.4% of the GDP. Aditya asks us that considering that the government has given a tax exemption in the budget, do you think they will be tempted to increase indirect taxes to meet this fiscal deficit target?
What we see is that, indirect taxes are regressive in nature. So increasing indirect taxes would be challenging, and ideally it should not be done. What we are seeing as we discussed, when we look at deeper the budget numbers, we see that some of the fiscal deficit is sought to be met through non-tax revenues, which is RBI dividend, and also through expenditure cuts. Maybe Capex the government may not be able to spend, so there would be some underspending there, and saving. And also, as I said, revenue expenditure as excluding interest payments, it's not declining in absolute numbers, but the growth rate is tapering, and as a share of GDP, it is declining. So there also there is going to be saving. We see that, in subsidies also, There is some rationalization that we have seen, which is again a welcome step, marginal rationalization. So again, as I said, it's a combination, but clearly the government should steer away from increasing indirect taxes, because indirect taxes by their very nature are regressive. So it will dampen consumption rather than increasing it, because there were these twin demands of not only cutting income tax but also cutting GST.
Yeah.
Because cutting GST will have an impact on a wider population as compared to just income tax. So I don't think the government would go in the direction of increasing the indirect taxes.
That's a great point. Added to this question of fiscal deficit, since you pointed out that another way to increase, to decrease the fiscal deficit would be to increase reliance on the RBI and other forms of revenue. There's a question related to that which asks that does that make the budget plan more unstable and more prone to international trade shocks?
Absolutely, that's a very valid question, because we are this question needs to be asked and thought through, that reliance on RBI dividend, is it something which is a healthy practice going forward? Because in 1 year we have got good dividend, like this year 2.1 lakh crore, but is it possible to keep getting this higher dividends amid a period of trade uncertainty? So that is, as I said earlier also, that while the budget has pegged again a very big number for non-tax revenues, primarily in the form of dividends from RBI, going forward there needs to be some rationalization and rethink on the reliance on non-tax revenues, keeping in mind the global uncertainty.
Now, there's an interesting question by Advaita. She asks that in the last year elections, the BJP government prevailed in the form of a coalition, which represented a switch from their previous majority. How much does this change in the legislative balance of power influence Finance Minister Sitharaman's burden of credibility in the budget?
I think the general direction has remained same, even though in the coalition governance as well. The general direction has been moved towards fiscal consolidation, not too much reliance on freebies and populism. We have not seen that. No, there are some couple of positive developments in the budget, in addition to sticking to the path of fiscal consolidation and rationalizing revenue expenditure. There are a couple of schemes for coalition partners, but they are mainly meant to be financed through external funding, through multilateral development banks. So it's not going to have a very big impact on the country's fiscal deficit. So there is sought to be a balance, and the general direction of budget making, the general set of priorities to focus on macro stability remains even with the coalition governance as well.
Now, let's just end the session with the same point that we began with, which is the tax exemption given to the middle classes. Another question by Aditya again is, what are the parameters that we should keep a close eye on to see whether this tax exemption moved by the government is actually boosting consumption spending? Is it GST collections or is it some other parameter?
It's a combination of a number of parameters, but first thing first, we should see that it may not lead to an immediate boost, though that is important. But going forward, various high frequency indicators are there to assess consumption. GST collections, certainly. The other is the commentary that is provided by the FMCG, the fast moving consumer goods companies, because that is very important. It tells us, their investor presentations, when they talk to their investors, they tell us the pain points, they tell us whether the demand is originating in the rural sector, or is it more in the tier 2, tier 3 cities, or is it more in the urban sector. So I think this disaggregated view, looking at the finances of consumer goods companies, looking at the commentaries, looking at the experiences of companies that are in the business of consumer durables, that will likely give us a sense of whether the consumption is getting impacted by this or not. But it may not happen in the immediate quarter. It will take some time once people understand that how much is going to be their increase in disposable income, and then how much is going to be tax saving. But going forward, it should start showing up in the various data that we normally look at, be it auto sales or be it the white goods sale or be it consumer loans for consumer durable goods, a lot of things. But as I said, FMCG companies' commentary is something which is very important to get a sense of the direction of consumption going forward.
Great. And we will keep an eye out for that. On that note, that's all we have for you today. Thank you so much for joining us. Thank you, Radhika.
Thank you.